Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing 3 stories. First, Eli Lilly's stock plunged 13% after its new obesity pill seemed to underperform the drug from Novo Nordisk. So we'll reveal why Goldman Sachs is betting billions that Lilly will actually win the war. Then, Bank of Japan Governor Kazuo Ueda is signaling a massive economic shift after a historic 5.25% wage hike. We'll explore how this is fueling a robotics boom and threatening the cheap money era for startups. And finally, a staggering $60 billion has flooded into hyper-speculative ETFs this year, but institutions are staying away. We'll unpack the SEC's warnings and why one expert is calling the trend a train wreck in the making. The most unexpected news in the finance world today has to be this. Eli Lilly's stock plunged 13% in a single day after trial data for its new obesity pill underwhelmed Wall Street. On paper, it looked like a clear loss. The pill showed less weight loss than the rival drug from Novo Nordisk, the titan behind Ozempic and Wegovy. But this initial reaction highlights a huge disconnect between what investors often look for and what actually drives mass market success. Wall Street can be laser focused on one metric, peak efficacy, or the absolute best result in a controlled trial. But real world success is far more complicated, but that's not the whole picture. The real turning point isn't happening in the lab results, it's happening in the global supply chain, and some of the biggest names in finance are betting on the supposed loser to win the war. Now, get this, while Novo Nordisk pill appears slightly more effective, it's a complex drug that's expensive to make and comes with strict dietary rules. Patients have to take it on an empty stomach and wait 30 minutes before eating or drinking anything. And this is where the chemistry becomes absolutely crucial. Novo's drug is a peptide. Think of it as a delicate, complex chain of amino acids. Peptides are notoriously difficult to get into the bloodstream when taken orally. They often have a bioavailability of less than 1% because our digestive system is designed to break them down. This makes them incredibly complex and expensive to manufacture in a pill form that works. And those strict dietary rules, they are there to maximize the tiny chance the drug has of being absorbed. Research shows that medication non-adherence or patients not following the rules is a massive problem, contributing to over $100 billion a year in avoidable healthcare costs in the US alone. If a drug is hard to take, people often just don't. Eli Lilly's pill, on the other hand, it's a simple, small molecule drug. That means it's easier and cheaper to manufacture at a massive scale. There are no food restrictions. We are talking about 2 fundamentally different types of chemistry. Small molecule drugs are built through well-established, efficient chemical synthesis. They are more stable and easily absorbed by the body. This isn't just a small tweak, it's a foundational advantage in production. One analyst at Leerink Partners put it bluntly, saying Lilly plans to, quote, blanket the world with orforglipron and that it can launch globally in an extraordinary manner with lower prices. And the rabbit hole goes deeper. Goldman Sachs is forecasting the global weight loss drug market will be worth a staggering $95 billion by 2030. Within that, they predict oral pills will capture a $22 billion slice. These numbers aren't just about wealth, they're about access. The high cost and complex manufacturing of current drugs have created a massive barrier, especially in low and middle income countries where obesity rates are also soaring. A cheaper, easier to produce pill could fundamentally change who gets access to treatment. So the thing is, Goldman analysts expect Eli Lilly's supposedly weaker pill to capture a 60% share of that oral market, pulling in roughly $13.6 billion. They predict its rival, Novo Nordisk, will only capture 21% or about $4 billion. Essentially, Goldman is betting that convenience and scalability will crush a small efficacy advantage in the real world. They are betting that millions of people will choose the pill they can take with breakfast, and that Eli Lilly can actually produce enough of it to meet that demand. It all comes down to a central question for this multi-billion-dollar market. What matters more? A few extra percentage points of weight loss, or a pill that's easier for millions of people to take and for a company to produce? The battle for the future of weight loss may not be won by the strongest drug, but by the smartest. We were just talking about a high-stakes battle between corporate giants. Now let's zoom out to a battle for an entire country's economic future. In Japan, the era of stagnant wages and deflation that has defined its economy for a generation is officially on the ropes. The signal is coming straight from the top. Bank of Japan Governor Kazuo Ueda just went on the record with a bombshell statement. Wage growth is no longer just for large corporations. It's now spreading to small and medium-sized firms across the country. What really brought this to a head was the latest wage data. Japanese companies just agreed to an average wage increase of 5.25%, the largest in over 30 years. This is a critical development because a recent survey showed over 65% of small and medium-sized businesses are already reporting manpower shortages. So for them, raising wages isn't just an option, it's a survival strategy. But to afford it, they have to boost productivity, which is why many are now accelerating their adoption of robotics and AI. This is creating a huge domestic boom for Japan's own world-famous robotics industry. However, if you zoom out, you'll see another layer of strategy at play. The trigger for this massive shift was, paradoxically, the global inflation shock from the pandemic. According to Ueda, that external pressure finally broke Japan out of its deflationary equilibrium. Now, demographic shifts that started back in the 1980s are culminating in what he calls acute labour shortages and persistent upward pressure on wages. And Japan's demographic challenge is so profound that it's reshaping the entire country's research and development priorities. The government is pouring money into what's called age tech. The country is facing a projected shortfall of nearly 400,000 specialised elder care workers by 2025. In response, they are pioneering assistive robotics and AI-driven tools to help care for the elderly and extend the productivity of every single worker. This isn't science fiction. It's becoming national policy. Companies are being forced to compete for workers, driving, pay higher. Believe it or not, this is also fueling a cultural revolution against the idea of lifetime employment because technology is making it easier than ever for workers to switch jobs. A recent report found that over half of all tech professionals in Japan are planning to change employers within the next year. AI-powered job platforms and remote work tools are creating a dynamic, competitive labour market that simply didn't exist a generation ago. So what's the ultimate consequence of all this? The answer is a fundamental change in monetary policy. After ending a massive decade-long stimulus program, the Bank of Japan is now signalling that the conditions for another interest rate hike are falling into place. For the last decade, Japan's booming startup and venture capital ecosystem has been fueled by ultra-low interest rates. Venture investment grew from just $600 million in 2013 to over $6 billion in 2023. Now, that era of cheap money is ending. Higher borrowing costs will force a major pivot, pushing startups to focus less on speculative growth and more on sustainable, profit-focused business models. This isn't just a minor adjustment, it's a potential turning point for the world's fourth largest economy. The pressure is mounting. Consumer inflation has already been running above the central bank's 2% target for well over 3 years, and Wall Street is taking notice. A recent poll shows nearly 2/3 of economists now expect the Bank of Japan to raise its key interest rate again this year. After decades of economic hibernation, the question is no longer if Japan is waking up, but how fast it's about to start running. Speaking of cheap money, a different kind of financial frenzy is heating up in the markets, fueled by investors chasing massive returns. A staggering $60 billion has flooded into some of the riskiest funds on the market just this year. And the so-called smart money, the big institutions, want almost nothing to do with it. This has created a massive divide that has experts issuing stark warnings. So why are everyday investors flocking to these products now? Research points to a perfect storm of factors. We're seeing the gamification of trading on mobile apps, making speculation feel like a game. And then there's the huge influence of social media, where viral trends can sway investor sentiment in a heartbeat. It's a behavioral phenomenon where many are chasing returns without fully understanding the complex machinery under the hood. We're talking about hyper-speculative ETFs, think single stock funds, or leveraged and inverse strategies designed for massive short-term swings. To understand the risk, you need to know how these leveraged funds actually work. They are designed for daily performance. They use complex derivatives and rebalance every single day to achieve their goal, like providing double the daily return of a stock. The reason this daily rebalancing is so critical is that if you hold them for longer than a day, the math can work against you and you can lose money even if the stock you're betting on goes up over time. This is a risk so significant that the US Securities and Exchange Commission itself has issued specific warnings about these single stock ETFs. highlighting their complexity and potential for amplified losses. When we place the retail frenzy alongside the institutional caution, the contradiction becomes clear. While institutional investors dominate about 64% of the overall ETF market, their footprint in these risky areas is tiny, making up less than 10%. According to ETF Action founding partner Mike Akins, these strategies are a staggering 99% owned by retail investors. Billions of dollars are pouring in, while institutions are largely staying on the sidelines. So if the big institutions are avoiding these, who is making and selling them? Well, these funds are a lucrative business. The firms that create them charge much higher management fees than your standard index fund, and their marketing often targets retail investors directly. In fact, some reports show asset managers are increasingly collaborating with social media influencers to promote these very products, which raises some serious ethical questions about pushing high-risk strategies to a less sophisticated audience. And Akins is sounding a major alarm with a direct warning. For some of these products, he says it's a train wreck. He points specifically to yield-focused ETFs tied to single stocks, some of which advertise payouts as high as 100% annually. The dangerous catch? If the underlying stock falters even slightly, those massive income streams can become completely unsustainable and the strategy collapses. And the concern here goes beyond just individual losses. A train wreck in these funds could have ripple effects. To maintain their leverage, these funds are forced to buy more of a stock when its price is rising and sell it when it's falling. This forced selling during a downturn can create a dangerous feedback loop, pouring fuel on the fire and making a market drop even worse. Some studies have even compared this mechanism to the strategies that contributed to the 1987 stock market crash, highlighting the potential for these funds to destabilize the market. So if this surge in retail risk-taking sounds familiar, it should. Experts say it harkens directly back to the 2020 and 2021 pandemic era boom in thematic funds like ARK Innovation, which saw huge retail-driven inflows right at the height of the bull market. The historical parallel is raising red flags across Wall Street. The money flow into these speculative products is once again approaching those peak levels. It leads many to ask if this is a powerful contrarian signal that the entire market is overheating. And all of this activity has not gone unnoticed by the watchdogs. Regulators at both the SEC and FINRA are actively scrutinising whether the current rules are enough to protect everyday investors. There are ongoing debates right now about implementing stricter controls, enhanced warnings, or even new rules to limit access to these complex products. The big question is whether they can act fast enough to prevent widespread losses. Time and time again, this kind of money chasing, this kind of return has flashed a warning sign that investors can't afford to ignore. This content is for informational purposes and should not be considered investment advice. The ETF market involves various risks, and past performance is not indicative of future results.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.